This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Today I have another mega episode, a combination of 4 prior trend following episodes. 4 of the most successful trend following traders alive today. I'm not going to give a big introduction right now. You can do a little homework and you're going to figure out who they are as I interview them. But the 4 that follow, you really might consider paying a little bit of attention to. First, Ewan Kirk. Then Jean-Philippe Bouchot, then Martin Luke, and finally, Christopher Cruden. I hope you enjoy this fantastic collection of trend-following minds. First out of the gate, Ewan Kirk. If you'll indulge me for a moment, I would love to go back in time a little bit. And I'd love for you to paint the picture, because we're going to break apart your trading strategy, your management strategy. I want to break all that apart. But before that, a guy with a PhD in mathematical physics going to Goldman Sachs, you weren't the guy that was living and breathing trading when you got there, were you?
Not at all, no. When I turned up for my first interview at Goldman Sachs in 1992, I didn't actually know who Goldman Sachs were. I thought that they were a bank, but apart from that, I wasn't entirely sure. So no, I didn't live or breathe trading. I didn't even live or breathe quantitative finance. Probably couldn't have discounted a cash flow.
So they were looking for a certain type of thinker, a certain type of thinking.
Yes, they were looking for somebody who had some sort of mathematical background, and computer programming is also important. I say this to just about everybody that we interview, that it's sort of useless being a mathematician, being a statistician without being able to computer program, or without being able to program a computer rather, because it's like being a novelist who can't write. The way that you express your views or express your ideas is through programming computers. And so I was a reasonably good computer programmer. I had a background in quant, and Goldman very kindly took a punt on me.
I saw that your co-founder, Eric, he called programming, he said it's today's literacy. You have to have it.
It's today's literacy, and that strand runs through a lot of my career, but also runs through what we do at Cantab. Everybody programs. I myself have just spent the last 2 or 3 weeks programming up a piece of our infrastructure. There's no rest for the wicked, as they say.
But as I lay that foundation, as you talk about your background, it's going to look to the audience out there that there's this perfect physics mathematical background. But you're also a guy that you go to work at Goldman Sachs, and I've seen this mentioned in the press. You allowed yourself to turn up at a black tie dinner wearing a kilt.
Yeah, that's true.
But I'm curious, though. You're not a cavalier guy. Obviously, you're very grounded. You're very, you think in terms of risk. So, but what was your thinking there? What is your thought process that you allow yourself to stand out like that?
Truth is, of course, that for somebody who, like myself, originally came from Scotland, the traditional black tie dress is a kilt and all of the attendant bits and pieces with that. So it's not like I turned up in a clown costume.
I hope you did not infer that that's what I was saying.
No, I'm smiling as I'm saying this.
Okay.
But I do think that one thing that Goldman Sachs was very good at doing, and presumably still is it's tolerant to some degree of idiosyncrasy. Certainly in the early days, Goldman was a partnership with maybe 150 partners running their small businesses. That made it very much a meritocracy, very much a what have you done for me today kind of thing. Me turning up in a kilt is not the strangest thing that I've seen, but it's a place where really much more so than other banks, certainly in the 90s. It was a place where all Goldman was interested in were you good at your job? Within certain limits, obviously, turning up at in a clown costume at a client meeting would probably be a very quick way of getting fired.
I mean, I took it as a complete outsider reading about it in a press account. I just took it as you saying, look, I'm going to march to some music that is standard, but I'm going to think outside the box. I'm not going to just be the guy that's clocking in. I mean, that's as an outsider reading it, that's how one takes it.
I probably couldn't violently disagree with that view. No. I think yes. There's certainly some of that in me, is to not just be the guy. Although to put this in context, Goldman Sachs, to take that as an example, Goldman Sachs is a very serious, very successful US corporate, and there's a limit to how outside the box you can think in a bank, and quite rightly too. Banks are responsible for a lot of risk for their customers. They're responsible. They have a fiduciary duty in lots of cases. Yes, you can be a little bit idiosyncratic sometimes, but at the end of the day, it is a big US corporate.
I want to break apart some of your strategy ideas and how your firm operates, but I wonder if you would be willing to paint a picture for me. I'm curious, when I can look at the success of the London CTAs, the London quants, those many that have trend following backgrounds, why did the switch happen? Why did London become the spot? For example, so many of the long-standing early pioneer trend following CTAs were from the US. What was the switch flip?
That's a good question. It's not one I immediately have an answer for, but I can speculate. I think if we think about the very early trend following, the history of the industry is the very early trend following, the turtles. We're talking mid 80s there, maybe early 90s. The kickoff for the London, or maybe better to call it the European scene, probably happened in the mid to late 90s with AHL, obviously, the granddaddy of us all, and then Winton and Blue Trend and Aspect and ourselves and a whole plethora of really great firms in Europe. I think partly the reason why we maybe managed to become more successful or grow was more of a scientific approach to investment and statistics. I look back at some of these things that I see in the old tattered books about average true range and breakouts, and it seems like the dark ages. We are thinking in a much more statistical sense, much more scientific, I think. And it's not just enough that it happens to have worked. Possibly that's, maybe we can thank David Harding and the rest of the team at AHL for building that into the consciousness, and then it just takes off. Why? So the question there is, so why didn't the CTAs in the US follow that lead? I would clearly believe that a more scientific approach to investing, a rigorous statistical approach to it, I clearly believe that that's better than just a rule that happens to have worked in the past. But it's not clear to me why that would then not be transplanted back. I remember, even though we started in 2006, 2007, I do remember people asking me, again, particularly in the States, why do you weight your positions by risk? Why don't you just take a constant lot quantity? One lot of this, or 10 lots of this, and 10 lots of that, and 10 lots of the next thing. And obviously that's, there's no other way. That's just madness in a world where you have a contract like the wheat contract, which is maybe, $20,000, and the nickel contract, which is $250,000. It's just an insane way of doing it. But it was the tradition, and our industry is quite conservative. The idea there's a small subset of investors who want the new thing, believe maybe that there's some fabulous technique out there that's just going to predict what the S&P is going to be tomorrow. But there are also people who want it to be the way it was. And anything that steps outside that is maybe a little bit different.
Fair enough. Let me jump into some issues that are near and dear to you, central to how you look at markets, your trading strategies. You're talking to clients and you have to tell the new client, and this could be a very experienced client, perhaps they're not experienced with your strategy yet. And you ultimately have to bring up the conversation of, hey, look, losses are statistically inevitable. You can't get around that fact. Now, there's still a significant number of people in the population out there, whether they're very astute about investing or not so astute, they still don't want to imagine losses as part of the game.
Yep, people are desperate to invest in something which never loses money. And that is, of course, why Bernard Madoff existed. There's a great phrase by John Maynard Keynes where he said, in the field of fraud and deception, demand creates its own supply. Everyone is desperate. Everyone is desperate to invest in something that doesn't lose money. I'd like to invest in things that don't lose money. I'd like to come up with a strategy that never loses money. I mean, of course, we all want that. But the reality of almost all investing is that if you're really good and or really lucky and you've got a very long track record, maybe 20, 30 years, and you've never changed your strategy over that period, which of course none of these things are really true for anybody, maybe the best you can hope for is a Sharpe ratio of 0.8, 0.9, maybe 1. I know that there are some more liquid, say, stat arb strategies which can outperform that for a long period of time, and then, of course, August 2007 happens. But broadly, a good investment strategy, an outstanding investment strategy, is something which, over a long period of time, has a Sharpe ratio of 1. Investors should really want that. So, a 20% volatility with an average gross 20% return, that would be great. But that does mean something with, say, a 20% volatility. Every 2 years, it's going to have a drawdown of 15%, statistically. Every 4 years, it's going to have a drawdown of 20%. This is just what happens. Even if the system truly has that return profile, it's going to experience those kind of drawdowns, and it's going to experience losses. I have a little spreadsheet that I sometimes show to clients when I'm discussing this, which, and broadly we don't really use spreadsheets, but it's a nice little tool, which sort of simulates 5 years of returns, daily returns, from something which is a 20% return, 20% volatility process. So, effectively a Monte Carlo simulation, if you want to call it that. And every time you press F9 on this spreadsheet, it draws another graph of another realization of this random but positive process. You don't have to press F9 very often before you get a history which loses money in a straight line for 5 years, which has a 40% drawdown. And remember, this is something which is guaranteed to make 20% per annum over a long enough period. So the expectation of losses is something that everyone should build into their investment process at all times, and it's something that investors do. And the majority of our investors are institutions. They're pension funds, they're insurance companies, they're sovereign wealth funds, they're endowments. To be very fair to these investors, they are really quite sophisticated and they understand that. And so I think sometimes when you're speaking to maybe high net worth individuals or smaller family offices, the desire there to protect capital is much stronger. You have to be extremely clear about the fact that there are things that will happen in the future which will be unpleasant. The other thing you have to do is explain to investors when you're making money that it probably won't last.
Do you see the demand for that discretionary macro trader hedge fund that just says, trust me, I have the experience, I can call the direction, I can position these multiple futures contracts across all these different markets, just trust my discretion? Do you see the demand for that waning?
Obviously, by the time somebody's sitting on the other side of a table from me, they're probably not going to be asking me that question. And I am, of course, very clear about the fact, particularly when people say, well, do you take risk off? Do you put it on? How about taking off your bond position or adding more of this? I'm very clear about the fact that I cannot see into the future. I'm not psychic, so therefore I don't have any skill in that my skills lie elsewhere. There is an argument that, at least in terms of positioning longer term, maybe nobody has skills like that. Maybe it is just impossible. I could certainly argue both sides of that. I think the demand for discretionary trading probably comes from the reactive demand. It's extremely hard to write a model. Well, it's impossible to write a model that can react to every last move in the market or react to a piece of information that's coming in. I don't know. September the 11th is probably a very good example of a piece of information that arrived, the world changed at 9:02, and systematic models knew nothing about it, whereas discretionary traders clearly did. So in those kind of events, it's quite possible that discretionary traders will outperform, and I can understand why people have that demand for it. But it is an extremely difficult job to be a good macro trader, and we all know of those people who have great reputations in doing that, and it's maybe only a handful of people. Of course, the interesting thing about macro trading is that everyone wants to be a macro trader. It's really interesting when you hear stock pickers talk, discretionary equity long short people talk. Very often what they're talking about is macro things. We think the market's going up, we think it's going down, we're doing this, and then therefore we're going to buy these stocks. And quite often macro decisions are wrapped up in security analysis, which they probably shouldn't be. I really think trading macro on a discretionary basis is one of the world's hardest jobs, and it's possible that the people who are successful at it may just be the lucky pennies. I don't know. I don't have hugely strong views on this, but I think it is a very hard job.
So the macro discretionary guys, when they hear, and I'm just kind of painting an illustration, it could be the investors that are hearing from you for the first time, but the macro discretionary guys, when they hear that everything you do is systematic, from strategy selection, asset allocation, portfolio construction, position sizing, execution, and risk control, that everything you do at your firm is systematic, that's got to cause some people to just go, what the blank? How there's got to be that aha moment of like, hold on, this is an approach that's different.
I don't think we are exceptional. I think it's, obviously, whilst I know the people who run my peers well socially, I don't know what they do and how they sell themselves, but I would be surprised if any of the large European CTAs are talking about how they intervene in what they do and they make some decisions. Remember, one way to think about this problem is that, and there is that little bit from people where, well, we have a model, but we occasionally intervene. My view of that is not systematic trading. Systematic trading, I've used this phrase before, it's a little bit like being pregnant. You either are or you aren't. You can't just be a little bit systematic. I often say to people who, are maybe pitching me with systems that are a model that they then put a discretionary overlay on, I say, well, why don't you just run two books? Run the model in one book and run your discretionary overlay as another book, and then just see which one makes money. Once you think about it that way, the decisions, often this is a way for people to hide really quite complex decisions. Remember the point, that what we're all trying to do is we're trying to say what's more likely to go up tomorrow and what's more likely to go down tomorrow. And that's the decision. Now, what we have, and many other people like us, is we have lots of complex, or sometimes simple, models which have been tested statistically over many, many years, and then they're weighted using very sophisticated weighting algorithms and cost control measures and all of those other things, literally millions of lines of code running. And all we're trying to do is forecast whether or not something's going to go up or down tomorrow. Very often people intervene in their models by saying things like, well, I think vol's going to come off tomorrow, or correlation's going to go up, or I don't think this model's going to work as well tomorrow. Now that's a very complex statement. The amount of analysis you would have to do to say that, for example, a trend following model isn't working very well and is unlikely to work tomorrow, since it's so difficult to do that for something as simple as an asset, the idea that you can do it for something as complex as a model which is running on 120 different assets with various risk weighting and cost control measures on top of it seems to me to be unlikely.
Yeah, fair point. Fair point. Why don't you talk about part of your process under the hood, in the sense that you like the idea of prove a strategy is broken rather than it's right.
Yeah, I don't think I'm the first person to come up with that, in that, effectively that is the scientific method which has been working pretty well for humans since the Greeks came up with it. Science is about proving things wrong. Okay, it's not about proving things right. What you're trying to do is break your strategy. You can never really prove that a strategy works or doesn't work. Finance, despite pundits and newspapers and people on the television, and maybe even people on podcasts, filling what they say with certainty. This is going to happen. This is the best way of doing things. Our systems are better than somebody else's systems. Our stock portfolio is better than somebody else. I know this, I know that. Finance is full of all of that. But in fact, finance is dominated by randomness. Randomness is everything. And so, because randomness is everything, you need to be uncertain. You need to have a lack of conviction and dogma in certain things, because you want to be able to prove that things are wrong. And so, when we come up with a new strategy or a new idea or a new trading system, what we're trying to do is, at least in, when we're simulating it and running it through all of our systems, what we're trying to do is find out what's wrong with it. And then if you get what is literally months of testing and retesting and rethinking about it and thinking about things, different environments and so on, if it gets through months of that, then maybe it's going to work in the future. And these are all very weak, uncertain statements, but to a great extent the philosophy of what we do is around that uncertainty and of conviction. There's certain things I've got conviction about. Obviously, I've got conviction about the importance of technology. I've got the conviction about the importance of risk weighting or coherent portfolio design. All of those things I've got a lot of conviction about. But I don't have a conviction about any particular technique. You just do what you think is best and what you think will be persistent.
Yes, I love the way of dealing with uncertainty, because it seems like until the last handful of years in the financial fund management arena, so many people desire certainty. And so it's refreshing. And of course, as you say, you're not the only one. It's refreshing to hear that I just don't know. I'm doing the best that I can, but I don't know. And I really don't think anyone else knows.
Yeah, there's a little phrase that I sometimes use, which is that systematic trading it's what we are trying to do as scientists in finance is a little bit like sort of dimly being able to forecast what the weather is going to be like tomorrow. And it's like meteorology in that sense. It's full of uncertainty, and technology helps, and the models aren't perfect, and they don't forecast better than even the biggest computers in the world don't forecast the weather very well 5 days forward. But meteorologists are trying hard to improve that, both on the technology side and better theories about atmospheric circulation. And they're maybe not too bad at forecasting the weather tomorrow in certain places. Probably not in the UK because it's so rainy, but you understand where we are. In the past, a lot of investment has really been people looking at the sky and saying, "Look at that cloud; it looks like a dog." I think our way, and people like us, our way of doing it, I think it's what we do. I think it probably captures the realism of the world. The other sort of way of thinking about this is when, very often, and rightly, when something happens, either when you make money or lose money, or when a model does something or whatever it might be, there's always the question that everyone asks, whether or not it's internally, people at Cantab or our investors or journalists, why did this happen? It's a great question. Why did this happen? And what we try and do is approach the problem from the perspective of the reason why this happened was chance. Now prove that it wasn't chance. Very often that's quite hard. You have you have a bad month or you have a great month. People say, well, what happened? Say, well, can I prove that it's any different from chance? Quite often the answer to that question is no. But it's just a different mindset. And obviously you have to approach problems in lots of different ways. But approaching a problem from the mindset of, I think this might just be a result of random noise, let's see if we can prove that it isn't, it's intellectually satisfying, if nothing else. I think it's quite a powerful technique.
Let me ask something, I don't know, I'd really call it controversial, but I saw this great article that was about you, featured in the New York Times. And I kind of went through some of the comments, and I noticed some of the comments were highly negative, and the thrust of the comments were essentially that you don't bring value to the economy. And I thought to myself, because I know something about what you do and what your peers do, and I thought to myself, those comments misunderstand, because there's so many of your investors, even if they're institutional investors, are representing the small guy. I mean, it's the small guy's retirement money that often makes it into the big institutional account. And so I think it's unusual that maybe people don't see that, yes, you might not be accepting Ma and Pa's retail account. That's not your position. But I think someone misses the point and misses the boat when they make that criticism. What's your feeling on that?
This is a hard question to answer. So the question is, are we doing something that is socially useful? Are we doing a good thing for the economy? That's a hard question to answer. Once you start going down that route, what is useful to the economy, or useful to society? The world only needs one car manufacturer. It doesn't need hundreds of car manufacturers. It doesn't need hundreds of models. So every car manufacturer is kind of not doing something useful for the economy. Nobody really needs an expensive meal at an expensive restaurant. So expensive meals and expensive restaurants aren't really doing anything useful to the economy. Nobody needs podcasts. We can live without them. Once you get into that, then I think you're getting into sort of dangerous water. We are, I believe, over time, are providing something which is valuable to our investors. I think we are doing that as well as we can. We are constantly trying to add little incremental improvements that make the returns better. We won't make money every month, and we won't make money every year, and sometimes we'll lose money and sometimes we'll make money. But we are doing the best we can to produce positive returns for our investors. And our investors are, as you say, a wide variety of people. They're pension funds. It's as you say, mom and dad, as we say here in the UK, who are investing in this. And where I feel, although this is not quite the same as finding a cure for cancer, and it's certainly not the same as landing a probe on a comet, to use something recently, which are all fantastic things to do. This is what we do, and we probably at the margin make the returns of our investors' portfolios better in some way, either higher or lower risk or less correlated and so on. Where I think there's much more problem in people doing something which is not socially useful is when relatively simple strategies are dressed up as something very complex. People effectively just being an index tracker, doing long-only things, but just actually tracking the S&P index, but charging 2.20 for it. That's a very bad thing to do, I think. At least I believe that what we do is something that is intellectually rigorous. It's probably a good thing. The other thing to remember, of course, is that trend following, systematic trading, the money comes from somewhere. And if we make money for investors, somebody loses it.
And if you lose it, someone's gaining it.
Someone's gaining it. We would believe and hope that over time, we will make money more often than we lose, and that will, over time, give positive returns. But it doesn't mean that somebody is losing. And it's a very hard question to answer.
There's a game out there that everybody can play. Everyone can pony up to the table, and they can develop a strategy, and it is the ultimate game where everyone can try. And I'm not just being a homer trying to defend you from the comment, but I kind of look at it like, okay, you know what? And I'm not asking you to say this, but I can draw my conclusions about those types of critics. And it's like, hey, if you don't like it, go try. Ultimately, the libertarian in me is like, hey, I think we've got a lot of better things to do on this planet than draw those types of conclusions. And perhaps that if you look closely, you can see those positive things. But of course, we all know that some people will never see some positive things. So you can't convince everybody, right?
That's probably true. I'm obviously always wary about talking about politics in any public forum because it's not my job to do that. But, I do believe that we do a relatively good thing. We provide, if nothing else, I provide employment for 50 people in Cambridge, which is the small business side of what we do as well. And it's important to remember that, this little community that we have is an employer, and it pays people money and does all of those things as well. So I think, whether or not there's some great good out there that we all have to aim for, I do believe that, we run good small businesses, and that is a good thing. So I'm very pleased about the fact, and one of the things I'm very pleased about is that in 2006, Eric and I sat in a small office with 2 computers and a server that gave us electric shocks every time we touched it. And from that, we have built a business. It's a small business, and it's a business that, like any small business, can go through bad times and could potentially go bust. And all of the efforts associated with running small or medium-sized enterprises, we've managed to survive for 8 or 9 years now. And I'm really pleased about that. If I'm proud of anything, I'm proud of that.
Well, it's inspirational. It's inspirational. I would love you to expand on the idea, and I think I saw you say that you, unlike maybe peers or other firms out there, you like to ask clients what they like. Not necessarily force things on clients. If you could expand on that, because clearly some clients are not going to have the technical market know-how that you do. So there's going to be some desire for guidance. So maybe I'm taking a little bit of that out of context, but could you expand on the idea of seeking client feedback for what they want?
That's maybe taken a little bit out of context. I think it is important to understand what your client's utility function is, to use that scientific phrase. What are they looking for? What do they expect from an investment? And that sort of informs the way that you explain things to them. As you say, generally, although all of our clients are very knowledgeable and sophisticated in lots of different areas, and of course they have to cover all types of investments and all types of asset allocation, they're almost certainly less knowledgeable than us in the very area that we do, systematic macro trading or systematic micro trading. So I'm struggling to remember that particular quote, but I think the point here is that you do have to understand your clients' drivers. What is it that they are looking for in their portfolio? What do they expect? And it isn't a question of us sort of sitting on one side of the table saying, what do you want? We've got it. You just ask, we'll give you that. But understanding what drives the decision-making process, who their stakeholders are. We, for example, have 2 products. We have a original quantitative fund, which is higher volatility, it's 20%. It's higher octane, it's 2 and 20 fees, so it's very much in that mold of high octane, very diversified, systematic macro and micro trading. And we also have another product which is lower volatility. It's 10% volatility. It's much more scalable. It's got maybe just more basic trend and more basic value strategies in there, and it's available to investors at 1/2 and 10. Now, understanding your investor means that you can understand what their internal desires are. What do they need? If maybe they want a low-cost, very functional, but they want a low-cost system where it's lower volatility, and therefore the headline numbers are smaller. We all know that if investing in a 20% volatility product is too risky, then all you have to do is invest half your money in the 20% volatility product and keep half of it in your pocket, and you've got a 10% volatility investment. But somehow that doesn't feel the same as a 10% volatility investment for reasons that I really don't get. I mean, the pure mathematician in me says that's nuts. But nonetheless, it is true, and I'm human too, obviously, and I feel that. So I think it is important to understand your investor, who their stakeholders are, and by understanding that and communicating with investors at the right level for an investor. None of our investors needs to know or cares about the deep statistical details which might be embedded in some nonlinear Bayesian regression portfolio algorithm. And that sounds great, but they kind of don't care, and they shouldn't care about that. But they should care about things like culture, technology, people, research processes. And these are all things that we can explain and want to explain in great detail. And if you can understand what your investor needs and wants, then maybe you can explain those things better. I always feel that I'm not really in that camp of, and our industry is quite bad at this, the industry of, if I told you about my models, I'd have to shoot you. That's quite common, that sort of, I have to be massively secret, can't tell you about it thing. I think that's wrong. We as an industry are managing money for people, and it's their money, and they have the right to know, and we have the obligation to tell them what it is we're doing with it.
Yeah, fair point. And I think that probably has been one of the reasons that you guys have gone from zero to significant in fairly short order in a very competitive space.
Yes, we have. We were. I'll refer you to my previous thing about randomness. Some of that is, of course, luck. We had a good run. We didn't have such a good year last year. We're having a good year this year. These things. Some of this is randomness. But actually, apart from being open and transparent and supportive of investors and all of those things that you have to be, I think the other strand that runs through everything we do is that sort of aggregation of marginal improvements. Little small marginal improvements that really in of themselves maybe just don't make much of a difference. Let's say, we work out some way of saving ourselves 0.5 basis points in costs a day. That doesn't seem like very much. 0.5 basis point, that's a tiny amount of money. But it adds up to nearly 1.5% over the course of a year. That's great, right? We'll have that. And lots of those little marginal improvements are probably what distinguishes good funds from less good funds.
Ewan, where can we send people? People can go find more about you and your firm, Contab Capital, online. That's easy enough. And if I'm not mistaken, I think I saw you somewhere on Twitter as well, yes?
I think I don't really tweet anything about finance at all. It's not, I don't think it's the format of 140 characters is not really ideal for extensive thought and analysis of things. But our website's a great place to find out a lot more about the firm. All of the contact details are there, and that really I actually quite like our website. I think it gives a very good impression of the firm and how we work and our culture and the products that we have. So yeah, the website's a really good place to find out about Cantab. And obviously, if any of your listeners are in Cambridge, I'm more than happy to just drop in and see us.
Ewan, hey, my pleasure. Thanks for coming on today. I hope some of my questions were not too far out from left field, right field. I hope you seem to handle everything with aplomb and very smooth and diplomatically. So the one though about the guy that was the critic, he actually annoyed me more than anything because I was like, oh, I just want to strangle him. But
one of the things you have to remember in life is that not everybody's going to think that you're great.
Yeah,
and there are valid criticisms. I'm quite phlegmatic about these things. There's valid criticisms about systematic trading. There's valid criticisms about the finance industry, and just getting annoyed about it doesn't help. You've got to take those criticisms on board, understand why they've happened. There's been a lot of, as we know, and lots of stuff in the press about bad things that have happened in finance. Sure. People are right to criticize. I'm not going to get annoyed about it because maybe some of the criticisms are valid. We certainly don't have a monopoly on the truth.
No, but as somebody who's watched this particular space for a long time and going back many, many decades, I think there is something noble about the systematic guys that have done this for a long time. I think there's something, as you talk about the bad things in the finance space, the Madoffs of the world, or a particular strategy that blew up that wasn't so great, there is something generally consistent that you can kind of hang on to in this systematic space. Like you said, though, maybe things break and it all falls apart at some point in time, but knock on wood, for several decades or more, it's done pretty well.
I think you can probably summarize it as, I think people in the systematic space, we try harder. To use that old Davis ad, we do try. I know just about everyone in the European space. I know that everyone is completely focused on just doing the best thing they can, and I think that's great. There's very few, well, I've certainly never met any sort of charlatans or people that are just knocking together any old rubbish just so that they can raise some assets. People try really hard, and sometimes we fail, but on average, I think the industry succeeds. And the industry's been in the doldrums for 2 or 3 years. There's been trend following in particular hasn't performed very well for probably the last 3 years. It's performing very well in the last 3 months.
That's how it goes, though, right? It's it's not necessarily consistency. It can just come boom, and you all of a sudden have a September of 2014, and everyone goes, "Where'd that come from?" And you're like, "Hold on, that's trend following."
That's the way it works. That's an interesting thing for people. I explain when people say trend following hasn't worked for 3 years. If you take a simple trend following model and just run it across 100 assets, when trend following is working really well, it's maybe working on 60 assets and not working on 40. And when it's not working, it's working on 45 assets and not working on 55 assets. So there's never really been a period in history where trend following hasn't worked on something. It just hasn't worked on enough. And now, of course, we're in a situation where, and I've got to be careful always to say, we're not a trend follower alone. We do lots of other stuff. But, trends in bonds, trends in ags, trends in the yen, trends in energy. This is all working out really well. And we're in one of those golden periods where trends are working on quite a lot of different things. That too won't last. Over time, there'll be ups and downs. But over a long enough period of time, trend following and more generally systematic macro trading has done incredibly well. And presumably, and this is the little scientist and uncertainty in me coming out, and presumably with a reasonable degree of probability, it will continue to work in the future.
Hey, look, if anyone out there looks at a systematic quant track record and it's all black ink, then you've got trouble.
I refer you to my previous answer about Bernard Madoff.
Yeah. Hey, Ewan, it was a pleasure having you on today. Thank you for providing some great insights and experience to my audience.
It was my pleasure, Michael. Thank you very much.
Thank you. Take care.
Next up, Jean-Philippe Bouchot. I want you to elaborate on your physics background, but bring that into this framework of classical economics. Classical economics, the rationality of economic agents, the supposed rationality, the invisible hand, market efficiency. But for some reason, the idea of empirical data often gets left out of the equation. And I think, and I've seen this with some other traders that have had success, a physics background is different. It allows you to maybe look at the world through a wider lens.
Yeah, exactly. I mean, I'm surprised that you say all of this, because that's more or less what my usual message is, and you've captured it all in a few words. Yeah, it is true that I'm a physicist by training, and physics is of course learning through doing experiments, and you learn that theories are no good if they're not able to reproduce observations. And even if your theory is beautiful, if it doesn't fit, it doesn't fit, and too bad, and you just have to throw it in the dustbin and start again. So, as a physicist approaching economics and finance back in the early 90s, that's what struck me most, is that there's a philosophical aspect to the way economics and finance theories are built, very much axiomatic and imagining how the world could be or should be, and then developing the theories without much care about what's going on out there. So I guess that for a while it was justified to do that because data was not so easy to access. So the whole academic world has developed without data in a sense, and so people had to maybe supplement the lack of data by axioms and by ways of thinking that can happen too in physics, actually. But so perhaps I was fortunate enough to enter the field when data became very easy to access, and when looking at data and trying to make sense of data through a kind of vivid light on the failures and drawbacks of efficient market theory and Gaussian statistics, Black-Scholes, all this, to me was quite apparent that it was not enough to understand the world.
But you mentioned Black-Scholes model. It's still in use. So even though that systematic underestimation of risk is well known by people like yourself, it's still in use.
Yeah, I know. I've been ranting about that for ages, and one problem is students. You have to teach students something, and Black-Scholes is so easy to teach, and it's so beautiful mathematically that a lot of people just resent the idea of having to put it all down and start again with something more messy. Of course, the world is messy, and being messy, it's much harder to teach, to focus on the right things, and by definition, you have to form your intuition on something else than mathematics. And I think that's why physics is good at that, because it gives you a lot of examples where you can put your hand in the dirt and try to push on some button and see what happens. But I think the same should be more and more true with economics and finance now through two channels. One is the availability of data and the possibility to make experiments on data, simulations, that is, and even without data, you can do simulations. You can invent worlds of people trading according to certain rules, or firms producing according to certain rules, and implement whatever rule of thumb or feature of the world that you think should be there, and then just run the simulation and see what happens. And then what's very striking when you do that, first, it's fun because you kind of play God, and second, very quickly you realize that some of the rules just don't work. They don't represent at all what is seen out there, and others seem to capture something that's very close to reality. And so my impression is that by training people more and more with this type of background, this type of experimental background, in a strange sense, because experimenting with simulation is a strange notion, which actually even in physics it took a little time for people to accept that simulation was a legitimate way to do science. I don't know if you know Mark Buchanan. He's a science writer, and he wrote a few years back something on numerical simulation, which I like a lot. So if you give me 1 minute, I'll find the exact quotation, because as I said, I think he's spotted it right with his own well. Okay, so I have it. So Mark Buchanan, in an article, op-ed, I think it was, in the New York Times, just after the crisis in October 2008, said the following: "Done properly, computer simulation represents a kind of telescope for the mind, multiplying human powers of analysis and insight, just as a telescope does our powers of vision. With simulations, we can discover relationships that the unaided human mind, even with the human mind aided with the best mathematical analysis, would never grasp." And for me, this is the essence of what the physics way of doing things has brought to the game.
Just so people don't think that perhaps you're giving an interesting marketing story about a physics background for your trading firm, your firm does not hire traders. Am I correct?
Yeah, it only hires physicists. And okay, people can think that, but we've been saying the exact same thing since the mid-90s when we started. And I know for a fact, for two reasons. Well, first of all, because the everyday life of CFM is driven by data, is banging our heads against data and trying to make sense of what we see and make models inspired by what we see. And the second thing, which shows that it's not pure marketing, is that I think we're very strange as a trading firm to have published something like 100 scientific papers in the last 20 years. All published in academic journals, which shows that it's really in our DNA to consider science as the right way to do things, if you want.
Well, let's jump right into my primary reason for reaching out to you today, which was seeing your paper, which really didn't have any big fanfare, just kind of all of a sudden appeared in the internet ether, and 2 centuries of trend following. And I wonder if you might lay out a scenario for how that paper came to be, and then we can discuss some of the specifics inside it.
Okay, so as I said, we've been publishing papers for 20 years now, and this particular paper was on the back of our mind for a long time. There are 2 reasons for it to appear right now. One may fall in what you call marketing, which is that we've been launching in January this year a fund called Institutional Systematic Diversified, and a part of that fund is based on long-term trend following. So it is true that we needed to give some support to why we're doing that. And the second thing is that we recently, in the course of the very last few years, had access to much longer time series than we had in the past. And in particular, we've been able to go back to beginning of the 19th century on commodities and indices in terms of data. And so this allowed us to backtest quite a number of ideas, and in particular trend following. And in a sense, to our surprise, we realized that the strategy has been extremely consistent since, well, as long as we could go back in the past. And this seemed to us to be a very interesting finding on the year where the Nobel Prize is given to Fama and Schiller and Hansen as well. But this debate on the efficient market hypothesis, on which I've been pretty vocal myself in the last 10 years, I think it's it is ironic that it's given to Fama, who's still arguing that there's no bubble, there's no crashes, that the market went down in 2008 in anticipation of the crisis and not the other way around, and that everything is perfect. And trend following, momentum in general, is something that efficient market theorists have a real difficulty to explain, because that's completely out of the framework. I mean, it's very hard to evoke some kind of risk premium that would be associated with trend following. So it has to mean that markets are not that efficient. There's a lot of other clear discrepancies between theories and reality, but I think this one is a very genuine and clear one, which talks to everybody. I mean, just looking at the trend on the long time scale is giving information on the future motion of the market, then it really means that all the public information is not included in the price right now. So for me, it's both from an intellectual and commercial point of view a very interesting finding.
I thought the statement that jumped out at me was, and this is from your paper, quote, "The existence of trends is one of the most statistically significant anomalies in financial markets," end quote. And that's a powerful statement.
Well, we've been looking at financial markets in the last 20 years, and it's very hard to find extremely significant statistical effects. You can find them on the high frequency side, but then there's a lot of murky things around high frequency. First of all, costs are tremendous if you want to trade at high frequency. So it's not clear that all the high frequency anomalies that have a strong statistical signature are, as economists would say, very relevant from an economics point of view. On the other hand, these very slow trends, where a lot of money can pile in and has piled in, is of course much more mind-boggling in a way, and also has to be taken into account both for academics, but also from the point of view of professionals.
A couple of the other interesting facts that I thought in the paper, perhaps this is obvious if data is going back to the early 1800s, but trend predates trend following, which I thought was interesting. I think also too, and I'll let you expand on that and expand on this, is the idea that it's actually a very small percentage of traders employing trend following models that make up the volume. So the idea of trend predating trend following, and that actually the traders using these models today make up a very small percentage of the volume.
Yeah, I agree. Well, you can see it both ways. I would rather say that actors systematically implementing trend clearly is posterior to the existence of trends. But I would say that traders on aggregate using trends is probably the reason why trends are there in the first place. And people using trends have been around for 200 years. And that's my interpretation of what we see, is that there's a lot of people, of even small people, who on aggregate play the role of trend followers and therefore create these trends.
It's interesting also, you mentioned Fama and the split Nobel Prize. I had a chance to speak with Harry Markowitz recently, who's very lucid. And the point that I made with Harry was, Harry, did you find it interesting that when you wrote back in the 1950s, this is what we should be doing, that within a few decades, other academics had taken what you said we should be doing and had said, this is what we are doing? And his response was, well, I think you're going to have to talk to the behavioral economist about that. He didn't want to touch it. But his point being is that, I never said this is what it is. This is what we should be doing. And other people interpreted it to come up with these, as you might say, these hard axioms that became rules, the foundation of the efficient market hypothesis.
Yeah, it is a strange field in the sense that there's clearly interaction between what people do and what people observe, and the use of Black-Scholes in 1987 is another vivid example of how things can go wrong when wrong models are used. That's what makes the subject fascinating also for a physicist, because you have to go kind of one step further and try to understand how the models themselves might change the game. So actually, we came up with a simple model on how trend could lead to trend, or mean reversion could lead to mean reversion, and a priori both are equally possible. I mean, it's not clear that we could imagine a world where people would follow mean reversion rather than trends, but it seems that humans have such a propensity to follow trends. There's a lot of very interesting psychological experiments where you can show that when a small child sees 3 points aligning on a line, it gives him pleasure. So there's clearly we're wired in to extrapolate past trends, and that's probably a way to extrapolate the motion of a tiger jumping on us or something that makes us alive today. So my intuition is that it's much harder to go against the trend than it is to follow the trend. And again, there's a lot of very interesting psychological or even biological experiments showing that there's a lot of things, hormones going in and out our body in the two situations. One when we're conforming to the crowd, and the other when we're not conforming to the crowd. There's a pain associated not conforming to what's going on.
Classical economics has no framework through which to understand wild markets. And wild is your phrasing. And I wonder if you could talk to the idea of classical economics not having the ability to have a framework to see those wild markets, to see through them. But how do you, when you use the word wild, what does that mean to you?
Yeah, okay. So you're referring to a paper that I wrote in 2008 in Nature, which was just after the unraveling of the crisis, and this made me react very strongly because I felt that this was, in the cards, and of course other people had seen it coming, but I was not too happy with the way economists had been kind of dismissing all the attempts to introduce a little more wildness in the description of economic systems and financial markets. So actually, wild is a reference to Mandelbrot. Mandelbrot has introduced fractals. Of course, he's introduced also the idea of distributions without second moment, without variance, or infinite variance, and distribution with infinite means, and that's his classification of randomness, if you want. So he would call benign randomness the one that economists love, Gaussians and things where the average, where you can replace a heterogeneous system with its average. And we know, for example, this relates to the book of Piketty as well, that the distribution of anything in economics is so broadly distributed that very often it just doesn't make sense at all to replace a collection of people by an average people, by a representative agent would be the classical word. But coming back to Mandelbrot, benign randomness is the one that I just described, whereas wild randomness is the one that is difficult to tame. And it's difficult to tame because it's hard to speak about averages and variances. And so that's really what I was referring to when using the word wild. Now, why is economics in general not able to capture these big swings? It's very strange. It's because the models are constructed to be intrinsically stable. It's like, people insist on the fact that a rational world is a stable world. And so your model should be stable. And so economics model come up with equilibrium points which are intrinsically stable. That is, if you perturb them by a small amount, they're going to naturally go back to equilibrium. And this is so much ingrained in the model that it's by definition impossible to have a crisis. And what's interesting is that when you remove a few of these rational assumptions and introduce market imperfections, then it's very easy to find situations where the rational equilibrium of economists, even if it still exists, is actually unstable. It's perturbed by small external shocks in such a way that the system goes out of whack for a while, and this is what we would call a crisis. So I think that the mathematical apparatus is there to allow us to not only describe, but anticipate to some extent, or at least make space for crisis in the economic world. And for me, this is a fascinating topic of research on which we've been focusing in the last few years.
I'll leave you with this, but I think the fun thing talking to you is you sound like you're having fun with this subject. You have fun with what you do. You get to wake up every day and have fun. Yeah, exactly. That's totally true, and I'm happy you say that.
There's not much more to say, but you can just feel. I could feel it because it's an experiment to try and find empirical data, to try and solve the puzzle to the best that you can, given that there's always going to be uncertainty. And I think what I have loved over the years, talking to you today, many of your peers, is just that when one accepts uncertainty, there's a certain honesty to it. And I think it's a lot of discomfort for me when people are so certain about what's going to happen. And so I personally enjoy.
But I think that's a big difference between physicists and economists. And I think there's a lot to be written about this. And in a sense, I would say that we're privileged as physicists because we don't have to talk to politicians and we don't have to make statements about how the world is supposed to work, in the sense that, nobody's relying on us to make political decisions. And I think there's a huge amount of pressure on economists because they're under the spotlight. They have to come up with stories and decisions. And this means that it's very hard for them to take a step back and say, okay, I'm really going to try to understand what's going on here. And maybe it's going to take me 10 years or 20 years, but at the end of the day, we'll have a better theory for the world. And I've been said that by many people who said, okay, well, all this is great, but what am I going to say to my Ministry of Finance when he asks me about should I raise tax or should I do this or that? And it's true that it puts people in a bad situation because they can't think long term. And as you just said, as physicists by training, I think what we love is to be able to think that we understand something. And if we fail, well, it's okay. There's nothing wrong in failing. We know that the physics has had so many revolutions and so many things that people were actually convinced were true turned out to be wrong in the end. So it's an incredibly good vaccine against what you said earlier against certainty and a certain form of arrogance as well.
I guess to some degree you're expecting failure, and maybe some of the economists don't want to. They can't acknowledge that there might be failure.
Yeah, because the field is constructed completely differently for sociological reasons as well.
Yeah. Hey, Jean, I appreciate you taking the time today. This was great, and I hope you enjoyed it. And I think the audience will enjoy listening to your insights, and hopefully we can chat again in the future as the wild.
Very happy to meet you someday. Of course, we've liked your book. As you saw, it's actually referenced in our paper, and I'm very happy to have been able to talk to you today.
Yeah, it was fun. I appreciate it.
Now it's time for Martin Luke.
I was thinking about our call today. I'm thinking of all the assorted conferences that I've been at, and I was just wondering if we crossed paths that we never met or something. Or I don't know. You've done these events though. You've done these things.
I have. We've the one I remember seeing you at. I think there's a picture of it on your website. You had Larry and Ed. Is it Sakota?
That's often debated. Sakota. I'm not sure. I think it's Sakota.
How does he say it?
I think it's Sakota.
Sakota. You had him on stage with some. It wasn't ukulele. He got out his banjo.
Yeah. The Whipsaw song. So you were the audience for that, huh?
I was the audience for that.
That was probably an interesting audience. I probably would have, because when you're on stage for one of those things, you're in your own little world, and you don't realize that that's probably a pretty interesting audience at that moment in time.
Exactly. And it's it's voyeurist because you guys are having so much fun, and just you could be in a bar, the three of you, and the rest of us are like voyeurs.
I sometimes wonder, is it something that comes with age where you loosen up? Or do you think guys like Larry and Ed were always that way?
A bit of both. I obviously I don't know Ed at all, but Larry's always been he's always been older than me, and that will never change. Probably he's always been wiser than me. But, and actually I haven't seen him for a while. So whether he still gets wiser or whether he has just sort of plateaued and that wisdom is enough to carry him through, I don't know.
Yeah, I probably have more interviews with just me and Larry in his office on tape that I can't release. They're awesome wisdom, but there's just a lot of color there that I can't put out.
Yeah. I can believe that, Michael. Listen, it's a pleasure finally to get to speak with you. I have your book on my desk and have owned this for many, many years. So thank you for everything you've done for the industry.
Well, thank you. Thanks for the nice words.
I'm surprised we haven't spoken.
Yeah, it's just, it's kind of funny because it took me, and I should share a really quick story with you. The first time that I met one of your old friends, the head of Winton Capital, and I was in his office, and it was in 2005, and we had just met. It was just me and him and his dog. He started pulling up a screen showing me equity curves of assorted well-known US CTAs, and then superimposing his equity curve, and then just giving me that wry smile of like, did you somehow or another miss me? That was my first kind of inkling of like the London CTA scene, so to speak, was not at the forefront in the US.
Yeah.
And then there's just an exponential explosion of all of you guys that's just out of this world.
It's an interesting story.
I tell you what, why don't you go back in time? I'm curious, the first moment, and I'm really curious your age. And obviously I know some of the backstory for the audience. I mean, that people can do some Google searches and stuff, but I'm curious when you first saw in your mind and you said, wow, this quantitative style, this systematic style of trend following trading, coding it and trading over a diversified basket of markets, when you knew in your heart of hearts, this had changed your life, or at least you knew this could make some money.
Wow. Michael, I think the starting place, and I'm also just conscious of the audience. Michael, David, and I never quite had the luxury, if you call it that, of having a role model. It wasn't as though we looked out at the investment universe and said, I want to be that person, or I want to do that thing. Certainly for Michael and I, because we go back further than Michael and I go back further than our relationship with David. We were at boarding school together from age 13, and then we were at Oxford together. After Oxford, Michael went to work for his father, who ran a small physical commodity broking business in London. I went and took my first job at Nomura, trying to sell Japanese equities to European investors. And Michael, I didn't know what an equity was when I started that job, clutching my physics degree. I was just fascinated by the analysis that Michael had started doing, prompted by his father. So Michael's father said, here, boy, buy one of those newfangled computers. There was, personal computers were just beginning to reach the shores of the UK in the 1980s. And Michael bought a Hewlett-Packard 9816. His father, handed a book of technical trading methods and said, see whether there's anything in this. So the point in answering your question, it's really been so gradual, just over time. I left Nomura, joined Mike. This whole time series analysis just lent itself to, the nerdy physicist's approach. We just discovered some things. We tested every model that we could encode from that great book. We distilled them down to some fundamental rule sets. We tried them on a range of markets. And at that time, Michael, the range of markets that we had available to us sitting in the commodity world of London was what do we have? Cocoa, coffee, sugar, aluminium, copper, silver, something like that. You know, the financial commodities were really in their infancy. So it was only a few years later and largely, you know, once we'd met David, that we started expanding the application of these models to a more diverse set of markets. So, sorry, I have a tendency to long-winded answers. But
no, I'm fine. I think the audience is fine. People love that depth. People want to know what's going on inside the mind.
Well, you know, and that's what I'm conscious of. I can't, you know, there was no one moment where we said, yes, we have created, you know, the great imitator of, you know, who was around in those days? Richard Dennis, John Henry, the Mint gentleman. But Michael, we didn't know that. As we started doing, we just didn't know there was that U.S. industry.
Mid to late 80s, we're talking right now?
Even early 80s. So I started working with Mike in 1984. He was working for his father, I think, from early 1983. So I think the earliest AHL track record stretches from 1983. We met David, I want to say, in 85 or 86. And there was a bit of a tussle. David was working for Sabre Asset Management and was the understudy to a great chartist, a man named Robin Edwards, who ran a fund, very systematic, but no computers involved. And David just immediately, he was a Cambridge-trained scientist, and he immediately saw the potential for using computers to encode Robin's chart approach. So the Sabre folks tried to hire Mike and me out of Mike's father's business, and that wasn't going to happen. So in the end, we got David to join us in Mike's father's business. And then at the beginning of 1987, there was a little family tiff, which resulted in the three headstrong boys leaving with one client and setting up AHL.
Now, but at the moment you guys set up AHL, had you made enough money at that moment in time? You felt like I've got a little breathing room, or was it still kind of, we're not really sure what's going to happen yet?
We didn't have a bean, not a bean. In fact, you know, blood is thicker than water. Michael's father gave, as we parted company, and just said, because Michael's dad, you know, had built his business over the years, and it had morphed from that commodity broking firm into a small asset management business based on the models that the three of us were developing. He had a very, you know, in those days, a parochial or patrician's approach to managing money and to the clients. And then there was just a difference of opinion. We said, look, you can't behave that way with your clients' money. You can't take a paternal view of it. You have to be completely transparent. And we set off on our own. But we didn't have a bean, and Michael's father actually lent Michael £20,000 that we spent on computer gear and rent until we had generated enough fees that we could go and, you know, rent our own office and pay his father back. So, but gosh, it was a very long time before we had confidence in what we were doing, actually.
What were you, kind of a two-part question, what were you calling the style of trading amongst yourselves that you were executing? What were you calling the style of trading? And number two, talk about some of the early coding and how you went about the early coding. This was not the age where you could walk out and buy a TradeStation or a Mechanica software or something. This was hard coding in the bowels, so to speak.
Two parts to that. What did we call it? I don't know. Yes, it was trend following, and it wasn't long before we woke up to the fact that there was an industry here, because we had friends in the brokerage community. So again, through Michael's father's connections, there was a firm in London back in the 80s called Rudolph Wolf. They were a metal broker, and they had cottoned on to this idea of raising, I mean, as you know, Michael, the roots of managed futures was a client would open a managed account and give authorization for the manager, in our case, AHL, to manage that money. So it was brokers like Rudolph Wolf and some of the early physical commodity brokers that helped us and educated us in what the rest of the industry was doing. So we knew pretty quickly that this was trend following, and we started to get exposure to a much broader set of markets. In terms of the modeling and the development, you had in Michael and me in particular real techie wonks. Certainly I would not get a job now as a developer, but back in the day, that's what we loved to do. You know, those Hewlett-Packard 9816s, actually the operating system was written in Pascal, and we learned Pascal and we built our models in Pascal. And very quickly, we built an environment that allowed you to encode trading ideas quite, much more simply. You didn't need to write them all in Pascal and compile the darn thing and blah, blah, blah. It was effectively an inline simulation language, which got developed in the days of AHL. Once we became part of the Man Group, and it was a well-funded exercise, we had, code writers, developers just working on that interpreted language. So it was a precursor to many of those, TradeStation, and for a while in the period between AHL and Aspect, certainly Mike Adam had a version of that. Actually, it wasn't his, but it was a similar product that he was marketing commercially. So the software development was very much intertwined with the model development, Michael.
I was thinking about some of my questions for you tonight, and I was thinking about the notion of achievement. And everybody, if they're pushing in some way, is achieving, and we're all striving. And so I think it's sometimes hard to reflect, because here I am, I'm really curious about all these little things. And I think from your perspective, you're just kind of saying, hey, we just started doing this, and it starts working, and we just keep at it. We keep our nose to the grindstone, and there's some ups, there's some downs, and next thing you know, 30, 40 years later, boom, boom, boom. We something interesting there. And then for a lot of outsiders, they look back now and they see the very successful firm Aspect today, but they don't really think about the progression, the evolution.
That's so true of so much in life, is that it's very hard to join dots when the dots don't exist.
Yeah.
You can join the dots with hindsight. So, if I was being really glib, there was a while where the three of us, none of us got those fancy jobs in investment banking that all of our slick friends at university got. So there was the period where, as three scientists, just nerding around with the models and the simulations and the back data and some of Michael's father's money, and heavens, this stuff works. The more we got into it, the more animated and the more excited we got. So we'd have various, there were little sound bites for a while. So it was Revenge of the Nerds for a little while. And then it was, investment bank in a box. Because in the early days of AHL, again, this speaks to just not having the sort of confidence in the models that we've built up, all three of us, over 30 years since then. In the early days of AHL, we did a number of different things, not only model development and asset management. I've spoken about the software development. Michael was already keen on commercializing that piece of software. I, meanwhile, spent a fair bit of time using the software to provide consultancy services for financial businesses. What came to light out of that, Michael, was that you could fairly easily model the behavior and the profitability of investment banks. We did a piece of work for a London gilt trading house. We modeled, how many people, what are their risk limits, what kind of investment horizon do they had the front book traders that were making a market, and they had the back book traders that were holding the house book, if you will, and we modeled the behavior of those things. And said, well, roughly, this looks like the profitability of your business. And the folks the executives that their jaws dropped. They went wide-eyed because we basically modeled their business. So, that there was we went round telling everyone, you can sack all of your, Goldman, Salomons, just get rid of all of the traders. They're very expensive and they have hangovers. You could build it all on computers. We didn't believe, we believed ourselves, of course, but everyone thought we were completely nuts. By and large, that's what's happened.
I want to jump up to the mid to late 90s in a second, but I have one kind of early type question left. The notion of systematic. So today, an aspect is 100% systematic, right? Strategies are systematized. When did you, I'm guessing that there was probably a moment where, okay, you're doing all this homework, you're in the early stages of this industry, you're seeing the results, but when did you have that aha moment that wow, we should really take the human discretion of the execution of this out, and we should automate this? When was that moment?
I draw attention to two things. The first was just an awareness that your ability to rationalize the available information, if you could do that pretty quickly and get rid of the noise, we'd all be much better traders. So I tell the story of in those early AHL days, Mike and I came up with a game, and it was just a piece of code that would randomly sample one of the markets in our database, and it might invert it and it might multiply it by a random factor. So you couldn't tell what the market was, but it would obviously keep the integrity of the price series, and it would present a chunk of a time series to you and then ask you to buy or sell, and you'd buy or sell, and then it would move forward a day, and then you'd buy or sell and move forward a day, and so on and so forth. And with that kind of rapid fire decision making, actually we were pretty good discretionary traders. If you blow each of those ticks up into a 24-hour period with news coming at you and fear and greed and, the chaos of normal life, you become a lousy trader. So that was the first inkling that taking the emotion out of it, just reducing it to the raw information has to be a good thing. The second thing, which I think is a theme we might return to, it turns out to be the importance of risk management, because what a lot of people focus on in any model development is the models. Are you going long? Are you going short? How do you feel about this market or that? And that's all well and good, and you obviously need to develop those models and be able to articulate what the underlying drivers are. But I think what many people miss is the risk management component. Where I'm going with this is that what a lot of people do is focus on systematizing the models, and then the portfolio construction and the risk management piece they leave to discretion. Somewhere in the genesis of Aspect, we realized that that's absolutely, that's a crucial thing to get right. You need to be able to systematize not only your models that interpret the price data and determine the confidence you have in that particular trend, but also you need to be able to systematize your portfolio construction process and your risk management process. So the manager that says, I am 95% systematic and 5% discretionary, Michael, is 100% discretionary. That's not necessarily a bad thing. I'm not saying that there aren't many geniuses out there who are discretionary, but it means you can't rely on the scientific process. You can't rely on the quality and the integrity of the simulation and research process if you're always resting on if there's the hint that you're just going to step in and down gear the portfolio when the going gets tough, or you're going to knock out a few markets when they, seem to be a little off the charts, because you can't build that into your simulations and you can't know what you're going to do in the future. So, over the years, although we knew at the outset that it was a good thing to systematize, over the years I've become more resolute in how important it is across the entire investment process.
You know, it's really interesting. You talk about that notion of 95% systematic and some portion of discretion. That was a very common marketing line in the disclosure documents of trend following CTAs for a long, long time. And it was almost like this mysterious thing, like we're 95% systematic, but there's this magical 5% discretion, which is the reason you're giving us money. And I always used to think about, this doesn't make any sense. Now I think probably because you and other peers, associates, etc., have gone the opposite direction and said, hey, hold on. I don't think you could probably get away today saying in the quote trend following space, we're 95% systematic. I think people that want to invest would probably say, explain that.
Yeah. Well, you know, it really depended who you were talking to, and we all lived in fear in the early days of the black box label. So I think there was also an element of, well, I think two things. I think that 5% discretionary was also to give some investors a sense that there was a thought process, and it wasn't just this, you know, ignorant machine clunking away. But also, I come back to the point that people built the models, and then, you know, for example, the overall risk target of the portfolio was something they would set discretionarily on how it felt that week, day, month, or epoch.
I just think it was a weird point in time where we had not yet got to the point where there was an acceptance of the 100% systematic. So there was this gray area in the marketing, and for good and bad reasons, perhaps, as you're saying.
That's exactly right. And now it needs to be used judiciously. So the idea of being systematic, the idea of being research driven, you know, as an investor, as a, you know, consultant doing your due diligence, you've got to scratch at that, because, you know, as I give a bright young graduate, you know, an infinite amount of data and an infinite amount of processing power, and they're going to come up with the works of Shakespeare, or they're going to come up with models that just look staggering. And you and I know, Michael, that you wouldn't put your money in them. So the difference between 100% systematic models that are based on, you know, curve fitting, back fitting, cloud patterns, data mining, versus 100% systematic models that are based on, you know, rigorous hypothesis extraction, testing, you know, and a whole barrage of statistical tests to make sure that you aren't fooling yourself. Big difference.
You know, I have to give a presentation shortly in a country in Asia, a pretty successful capital, and I assumed they knew what I was going to talk about. And they wrote me and they said, hey, can you bring these particular charts for your presentation and tell us whether or not these charts are in a trend or not in a trend? I guess where I'm going with that with you is the diversification direction, because it's amazing that people still, I mean, those people that ask me that, they want to fixate on their markets. They're excited about their markets, and they're not even thinking about diversification. That's not even on their horizon. They've just got their markets they're happy about, and they want me to tell them something exciting about their markets. They're going to be disappointed. But talk about the idea where that's not how you look at it. You are saying, what are the targets of opportunity? When that opportunity arrives, we're gonna do something with it when it arrives, but we can't force it. And I still think today, even in 2015, it's still not a widely understood concept.
I think that's right, and I've been in exactly those situations where, you know, whether it's the local conference organizer who's asking you to tell them how great their local market is, or it's the drinks party where somebody's saying, "What do you think about gold?" I have no opinion. I don't even know what country I'm in, Michael, and which way up your stock index is. But I know it's in my portfolio, and I know it's one of the 150 plus assets that we monitor 24 hours a day, and that we always have a position in. And depending on how those trends have unfolded, we'll have a larger position, and depending on how those trends have unfolded, we'll have a long position or a short position, and that's the beauty of it. So over time, our style, the way Aspect has developed, and I'm hesitating just because I acknowledge that it's idiosyncratic. Many managers will have a different approach from ours, but I start from the very high level premise that all assets have an equal opportunity to manifest trends. So the whole model building process is an attempt to preserve that opportunity and make it as broad and robust as possible. What do I mean by that? What I mean is that if you build your model such that it captures some of the characteristics of different markets. So you trade hogs subtly differently from how you trade treasury bonds, for example. You can think, you can squint and persuade yourself that you're building in some features of those markets, because clearly the world of hog traders is different than the world of bond traders. But I put it to you, Michael, the dynamics of those markets are, at that level of resolution, there is, in our opinion, no persistency. All you can say about hogs and bonds is that they have the potential to demonstrate trends. If I had looked at, say, equity markets if my data set was, this is somewhat spurious, but say 2000 and U.S. equities, 2002 to 2007, I could conclude that equities don't go down, or not for long. Or if I look at bonds over the last 10 years, bonds don't go down, do they, Michael? Never. So you could build into your model certain biases or certain scenario expectations, and that's what we try and eschew. We try and avoid those built-in biases. I am indifferent as to whether your regional equity market is in a roaring bull trend, which I know is what you want, conference organizers, or whether it's in a terrible, terrible bear trend. I'm agnostic as to whether it's going up or it's down. And I don't look at how different markets have performed historically and say my models are better at trading commodities than they are at trading financials, and therefore I overweight the financials. I try and keep it as completely agnostic directionally and asset allocation wise, so that it can grab hold of any opportunity that presents itself.
Let me see how I can ask this. So you've traveled a lot. You've talked to a lot of different people. You've had a long career on so-called, quote, Wall Street. What percentage, and this is clearly you can't give me an exact percentage, but I'm curious, when you're talking to people and you're meeting people after all these decades of going down this path, what percentage of the educated financial audience do you think really grasps what you do at Aspect?
Fortunately, Michael, many more now.
I think, is this a hedge?
than did for most of my career. I mean, the irony is that 2008 was largely for, I think for the majority of the finance. I mean, this is terrible generalizations and therefore probably not true. But from my small vantage point, 2008 was the aha moment. And before that, marketing what we did could sometimes be a struggle. And you know that. And the whole, the secular growth of our industry from being backwood, real cognoscenti, esoteric stuff. And we have to say we didn't help ourselves, Michael, with the absurd fees that we used to charge back in the 80s. The evolution of that to, making ourselves look respectable, and I want to be a hedge fund too, all the way through to, I think 2008 was where, as a result of that period of performance, 2009, the phone started ringing, and the pension funds and the pension fund consultants that wouldn't take our calls up until that point said, explain again how this stuff works. And then they were really receptive. And of course you can't make it up, because then ironically, of course, in the aftermath of the global financial crisis, you get a period where this stuff isn't as, didn't perform as well as it had done historically, and as well as our expectations would lead us to believe it does, and it can, and it will. So, to answer your question, I think that the vast majority of people now get what we do, but it wasn't until relatively recently that's been the state. That's been the state of the world.
Yeah, because you bring up an interesting point that 2008 was this watershed where people said, "Okay, wow." I put this in one of my books. The analyst. I don't think he's an analyst, but author. This kind of guy that talks on the shows on TV, Ben Stein, and he said, if you made money in October of 2008, you were doing something wrong.
Really?
and it strikes you funny because it's like, but I know where he's coming from. I mean, I know from the vantage and his understanding of sort of trading strategies or investment strategies, where he's coming from. And I guess if you only believe that, then I guess that's a fair thing to say. But it really, it's an amazingly, you're really leaving some things out to say that. But I just love that line, though. That's great, right? If you made money in October of 2008, you were doing something wrong.
I love that line. That is a great one, Michael. And I think that, none of us in our industry should think, and I think the respectable ones of us don't think that we've ever finished. It's not like you've ever, I've unlocked the secrets of the markets and my model is my model and now I'm off to the beach, because the markets never leave you alone, and B, there's always some new thing that you hadn't thought about. So yeah, in 2008, I think very topical at the moment is the evolution of portfolio construction, the theory and the practice of portfolio construction. You'd gone at the time, a very learned gentleman, Swenson, the Swenson model of diversification was don't just have US equities, have global equities. There you go. Now you're diversified. I'm oversimplifying it, but certainly he has had, and as far as I know, has no interest in quant strategies. And at the time, that was perceived to be a very valid and very useful form of diversification. And in 2008, that's why you get lines like, if you lost money or if you made money in October 2008, you were doing something wrong, because the worldview was so rigid. So I think it's exciting, and it keeps me young, and it keeps my research team young and energized, because there's always some new worldview that you should explore.
One of the things that I think is really interesting, I've had some of the brightest and most accomplished behavioral economists on my podcast, and what I really find amazing in talking to them is that their work seems to be the embodiment of the traders like yourself, your peers, the other associates in the industry, these going down this systematic quant trend strategy path was really, in many ways, capturing what a Daniel Kahneman was winning the Nobel Prize for, what a Vernon Smith was winning the Nobel Prize for. So I find it really interesting. But when I talk to them, it's amazing that there seems to be this disconnect where all these behavioral economists should be waking up to these quant trend strategies and saying, wow, what a wealth of interesting data and evidence for us to sink our teeth into. but there still seems to be a wall where they've not yet kind of like pulled the hood of the car up and looked under there and said, interesting.
Oh, I agree, Michael, and vive la différence. I'm very happy that that those folks and the folks at Google have not have not woken up to what it's do. But you talk about behavioral economists. One area that has sort of fascinated me and is the building of agent models. So if you can define players in your complex system, who are the hedgers, who are the speculators, who are the counter trend traders, all of that, you'd think you could come up with a bottom up model for the markets, which perhaps, I don't know, is that what behavioral economists are trying to do? In my limited experience, candidly, don't bother. It's a very elegant mathematical model, but it's very unlikely to be able to make you any money. I think the thing about what we do, Michael, is that it's a bit rough and ready. The models are very sophisticated, of course, and the mathematics is complicated, but it's you almost start from the premise that all markets will at some point display trends, and it's our job in these models to be able to capture those trends efficiently and not lose money in the periods where we're participating in those markets and they are not trending. There you go. I've just defined what it is we do, but you'll notice that I haven't dwelt on, and it's my job to tell you why those trends exist, where they come from and where they're going. And so I think if you fixate too much on that, which is the role of the behavioral economist, you very fascinating field, but it's not what we do.
Yeah, when I look at what they do, I just see, okay, they seem to do a great job of really putting aside the efficient market hypothesis and offering that, hey, human beings are not always so rational. Bubbles exist. And so if I just look at that very basic premise, their work gets more complicated than that, but that very basic premise, it kind of dovetails right into your world in the sense that it's kind of a foundational explanation for why you might be successful.
Yes. Yeah, and I think it is, and it makes for great reading, and often there are aha moments as you say, yeah, well that's why we sophisticated monkeys behave the way we do, and long may it continue, Michael.
Let me ask you kind of, as we kind of wind down, let me ask one kind of a current big picture issue for aspects. So I'm calling you from Southeast Asia today. The world is a very interconnected place. Everybody's coming online. If a country doesn't have a liquid futures market yet, they're surely thinking about it. They would surely like one. So we can all. How do you go about this process of bringing new potential opportunities, new potential trading opportunities into Aspect? Talk about I imagine you always stay excited because you're like, hey, we don't even know the next grouping of markets from the next country that's going to come online that can possibly offer us opportunity. I think what's so great about trend following, and in many ways, it is the Indiana Jones of trading in the sense that once you have your models and your systems and stuff, and you know that these markets in these countries are liquid and viable, you can go in.
Yeah. It's an ongoing process, and it's something we devote a fair bit of time and a fair bit of money to, because you've got to keep your heads up. As you know, Michael, it's relatively easy to get started with the 50 most liquid markets out there in the world. And if you just ignore all of the new stuff that you're referring to, you miss a huge opportunity set. As a business, we have a regular cycle of reviewing, news alerts, and our brokers keep us prompted of what's new, what's coming. We like to have some back data, so we're not going to be market participants on day one of an exchange opening, because we've got to get the sort of characteristic heartbeat of, liquidity patterns within that market before we can parameterize our execution algorithms. So we've got to establish a little bit of history, and then we've got to establish a threshold of viability, a threshold of liquidity, because it's got to be worthwhile. At a certain point, having a 1 basis point allocation to a market where it isn't viable in the program. So there's a liquidity threshold. I think there's something like 6,000. Is that right? 6,000 futures markets. Globally, you can very quickly cut off 80% of those on liquidity basis as being viable for what we do. And then it's an evolving cycle. As liquidity picks up, we will adapt our allocation in the portfolio. So, and the other feature, of course, Michael, is that there may be constraints. So, for example, we can't currently trade the Chinese futures markets for our investors because external investors are not allowed to participate in those markets. Similarly, access to Brazilian futures markets, which are vastly liquid. There's a taxation situation that makes them extremely difficult and expensive to trade. So all of those markets we're tracking, we're collecting data, we are simulating the models on them, and we're ready to go at the drop of a hat should the legislation change. And we welcome that. We love the additional diversification that it affords the portfolio, because back to the starting point, if you just traded the same liquid 50 markets that maybe we started with in the 1980s, if that was your portfolio now and all other things were equal, you'd have less diversification in the portfolio, because there's a long-term, a secular trend towards markets becoming more homogeneous over time, I believe. So we are hungry for new axes and new opportunities of diversification.
Why do you think you're so passionate?
I'm a one-trick pony. This is what I've done my career, Michael. I am, by nature, I can't claim to be a scientist or a physicist, but that's what I studied. And I think I got into that because I'm inquisitive and I like precision, and I like answers, and I like engineering solutions to things. So I know myself that I would be that I am a lousy discretionary trader. I like the application of sophisticated mathematical techniques and theories to extract signal from noise. And I love working with a bunch of really, really smart, talented people. All of that keeps you passionate to keep learning and to keep competitive and to keep doing what we're doing better and better.
I mean, even if the economics of this was much less, let's say it was good enough to earn a living, I get the feeling talking to you that this still would have been your passion and your path.
Absolutely. This is just great fun. I didn't set out on day one to be a great trader at all. As I said, I got into this working for Michael's father because I was fascinated by the application of computers to time series data. That's what I've done my whole career. It doesn't really matter that the rewards have been very good. That's a nice feedback loop, actually. Markets are a very, swift judge of how precise and how honest you have been. So
it's how to keep score.
It's how to keep score, exactly. And that means that I'm not in an amorphous world of where people could say, "Wow, what a great article you've written." There's a scorekeeper.
Yeah. Martin, listen, it was fun chatting. Hopefully we can talk again in the future. Everybody can go to Aspect Capital and easily find more information on your firm. Appreciate it. Great stuff. Where are you today? You're in America today.
Yes, I am, just outside of Boston. I'll be in London tomorrow and in Southeast Asia next week. I'm sure I will be hot on your heels and, in the aura of Michael.
Oh, you're too kind. Hey, Martin, listen, I appreciate it. Thank you very much.
Nice talking to you. We'll do it again soon.
My last guest for the day, Christopher Cruden.
And here's where I want to jump right in. Before we dig into your background, your current firm, and all that kind of fun stuff, I want to go back in time to something a little nugget that I put in my first book, Trend Following. And I want to read this verbatim, and it's quoted to you. And it says, quote, "I would prefer to finish with a certain currency forecast based upon my own fundamental reading of the market and one that underpins my personal investment philosophy. The only problem is I can't tell you when this will happen or which event will be first. On that basis alone, it seems best to stay with our systematic approach," end quote. Okay, are we done our interview?
That's about it, I'm afraid. I can't sing and you can't watch me dance, so that's about it.
That's a great line. And I did not know you when I put that in there. I just thought it was one of those nuggets I had saved. And I was like, it's just such a clear, and this is going back in time, and this is not new to you. You've had this attitude and this view going back to when? When did you become this man with this view?
When I discovered that everybody else I ever met was smarter than me, I thought I'd better stick with what I knew was an unimpeachable fact. And in terms of trading, that seems to be price. Everything else is some sort of weighted opinion or subjective opinion. And when it comes right down to it, I'm not terribly comfortable with besooted soothsayers and readers of tea leaves and chicken bones. So the price is the only reality. And so I'm happy to stand at drinks parties and give people my utterly meaningless and worthless and often wrong views. They're not really based on anything, are they? And my suspicion is nobody else's are either. It's almost like a circus trick. You watch these economists on TV, the sort of talking heads, and some of them are very entertaining, very amusing, and some of them are occasionally right. But I don't think I'd spend money on somebody's view.
Was there a point in time, a trigger as a young man, where you could have gone down the Eugene Fama route, you could have gone down the Warren Buffett route, but you didn't? So what was the pivot? Why did you not do that?
When I started off with Deanwood Reynolds years ago, and worked under the Managed Futures department there in Graham Capital, and Ken Tropin and all of that sort of stuff. So we met a lot of really clever guys, but many of them were, it seemed to me, systematic trend followers. When I came back to London in '88, I had a friend of a friend who was a very senior person at a firm called Singer and Friedlander, and he said, "I don't know what you do, but I know some people who do what you do," I think, as much as he understood it, because it was a very old British sort of stockbroker and that sort of environment back in the cities back then. He introduced me to Mike Adam at Adam Harding and Lewick. And it's a typical sort of British thing. Mike Adam and Marty Lewick had gone to a public school along with my wife's brothers, and it was very, very British. I met Mike, and we decided that I would join AHL. And in those days, there was AHL was AHL. I think we had a secretary called Eloise, and that's about it, really. And Martin Hunt, who was a brilliant guy, who used to execute the trades. So I joined them, and then I got a call from Mike, and he said, "Actually, I want you to meet David." I said, "Well, that's great. I'll look forward to meet David. David Harding, this is." And I said, "Okay, fine." So I went to see David, and David was showing me on one of these huge, big CRTs that they had back then, which was color, which was kind of unusual, because we're talking sort of Pac-Man visuals here, but this one had color on it, had graphs on it, and his fingers would fly across the keyboard, and another graph would come up, and then it would go into a heat map. Who the hell had ever seen a heat map? I mean, this is way before PowerPoint or any of that sort of stuff. I probably sort of looked askance at all of this, but what I was thinking was, could I do this? I mean, do I understand all of this? So I was looking sort of in a sort of a questioning way. And David sort of stopped, and he pushed the keyboard away. And he looked at me and he said, "Are you questioning what I'm saying?" Which I wasn't at all. I'm not in the slightest. I was in total agreement. And I said, "No, I'm not questioning what you're saying." And he said, "Good, because we have the intellectual high ground on this." Which at the time I thought was one of the most arrogant things anybody had ever said to me. And having been in the British Army, there's a lot of arrogant things that are said, but this set a new record. But I thought about that over the time I was with AHL. They did, in fact, have the intellectual high ground because they were ferociously clever people. David, Michael, and Marty, there's now Aspect, ferociously clever people. and sensible people too, despite the fact in those days we're all less than 30, I suppose. What I realized from that moment was that I was not going to be as clever as them. So what I decided to do was to take the one kernel of information, the one nugget from my experience with them and my smaller previous experience and much of my later experience, is that simple works. So what was the simple thing that AHL and other successful trend followers do? It is limit the amount of inputs, limit the number of parameters, and have the discipline and the conviction to follow your system. And so that's what we do. And I know that in this business people dress it up all sorts of different ways, but when it comes right down to it, that's all we do. What we do is in fact pretty simple.
Let me ask the question, your differentiating point as a trend-following trader primarily, the notion of going currency only, 7 currencies, this is your primary vehicle for applying trend following, correct?
Yes.
Talk about that. That's original. That's different, isn't it?
It was at the time we did it. After AHL was bought by Mann, I moved back to New York, and there was a man there called Bob Tomiso, who was my great mentor. He was an extraordinarily important man to me in my life and development. He was a systematic trend follower. His best mate was Larry Height. So Larry was always in the office and this, that, and we're talking 91, 92, 93, around about that time. Bob's CTA number with the NSA was something like 6 or something like that. So he'd been in it for a long, long time. And we noticed that at that time there were like 4, 5, 6, 7, 8,000 CTA registrations. And we thought that the business would become overcrowded, overpopulated. We didn't like what we saw in some of the smaller agricultural markets and the metals markets and that sort of thing. So we thought we would, the belief was, and I say it quite often, but the belief was that markets take on the personality of the participants, and if the participants are overextended, overleveraged, easily excited, inexperienced, easily spooked, this is in fact a bad market to be in. So we looked for a market that wasn't that, and we found what was those days the interbank currency markets, which were by definition a professionals market. They also have even back then, the advantage of being utterly and truly bidirectional. Stock markets clearly aren't, bond markets clearly aren't. Some futures markets you would argue that are or are not to a greater or lesser degree, but currency markets absolutely are.
Truly surfing, right?
Yeah, absolutely. It's just long dollar yen is short yen dollar. I mean, it's not hard, and there's no cost or moral view or legal impediment. It's just they were perfect markets, and so they loaned themselves, because the serial correlation that currencies seem to exhibit, to our kind of approach. So, and the product that came out was called Kintyre, which was, in those days we traded forwards. I think there were 28 different prices, and it was in effect, it was a sort of a one-size-fits-all algorithm, believe it or not. And we're a bit surprised as people today to hear, but we never even had a price feed in the office. That's not just because Bob was cheap, but because it doesn't. Watching red numbers change to green and back again isn't a particularly sort of constructive way of spending your day, especially if your holding period is as long as it was. So, of course, now it's entirely different. Now we've got all sorts of clever gubbins, which, as you've seen with the experience with Skype for this call, I don't fully understand. But nonetheless, back then there was none of that. So we traded once a day, as we do now, and everything was pretty simple, and the program itself was very successful. It had periods that weren't successful, then it had periods that were extremely successful. I think in the 10 years we ran the program, we probably had 2 losing years. The worst one was, I think, down to 2.54 or something like that, and other years were 30, 40, 50, 60% or more. So a very successful program.
I saw one of the comments in your newsletter quoting the Doors line, "Riders on the Storm."
Yeah.
You know, and noting that your program is something akin to a raincoat in bad weather. But that's not necessarily true in the sense that it's not only then that you can make money. I mean, you can make money.
Oh, no.
Yeah, exactly. So why don't you expand on that idea?
Well, in fact, that particular report, Riders on the Storm, I think we put that out about 15, 18 months ago. And we have just redone it. We've just redone the numbers. We haven't changed any of the words of the report because they're still valid and hold true. But we have changed or updated the files and graphs and charts and the numbers, that sort of thing. So we were early in putting that out. The benefit of a traditional portfolio, or specifically an equities portfolio, which is what Riders on the Storm concerns itself with, is entirely, from our point of view, accidental. It's an observed fact that exists with our program, rather than an objective that we set out to produce something. We didn't set out to produce something that assisted a portfolio of equities. It just so happens that after 14 and a half years, this is an observable fact. It does. It's sort of a happy accident that it does have this effect for equity investors. But it wasn't what we set out to do.
How do you describe operationally to investors? So we have a crazy period in the market, something like October of 2008, and your portfolio starts to do well. Equities are doing bad. But why don't you walk the audience through the idea of what's happening? You know, when equities start to go bad, people start to sell, and what operationally is happening that gives you the benefit to ride this increased volatility, this increased directional trending within your currency-only portfolio?
The answer to that question is to look at what are currency markets, and currency markets are basically markets for capital flow. So as there are seismic changes, such as a stock market declining 50% over a relatively short period of time, which they've done twice in the last decade or so, and vice versa. I mean, these are sort of big events. I didn't just mean the day of the quote-unquote crash, but I mean they are seismic events. And increased M&A activity, for example, it was very popular to ascribe certain moves to that sort of thing at one stage. What else would we have? The euro coming in, for example. Everybody knew what the targets were, so that's pretty much a layup. But these are seismic events that are reflected, or best reflected, in the market most appropriate for them, which is the foreign exchange markets. We don't make those things happen. We don't make anything happen. We just hope to hold on while nothing is happening, and for the time in which something good will happen, and we know as a certain fact that it will happen.
Have you ever had I'm saying this facetiously, have you ever had the Liechtenstein prince look at you and you say that you can't make it happen? Do some very well-heeled investors sometimes don't get that blunt, hey, I can't make it happen, but I'm still bringing you a very talented trading program with nice alpha generation, but oh, by the way, I can't force this to make money. Is that hard? That's hard for people to accept, isn't it?
It's very hard because it's sort of inhuman in a way, in the sense that people like to think they know a guy who knows something. And, it's hard if part of your presentation, or most of your presentation, is in telling them that you, in fact, are not that guy and you really don't know anything at all. So that goes down well with some and less well with others.
Well, I think it's once you start to open up and peel back the onion, so to speak, to get into the risk management, to get into the uncertainty, the volatility, how you're measuring things, how you're preventing the downside from going really down. I think it's when you start to open that up, I'm sure eyes start to perk up as well, ears perk up.
Well, I think what we make a point of trying to explain to people that our job most of the time is in not losing money. I mean, as David Harding used to say years ago, you'll always make money in this business if you don't go broke first. And that's very true. Now, what's going to make you go broke? Well, being wrong isn't going to help, but most people go broke because of leverage. So we try and stay with very small leverage relative to most currency managers, that's for sure, and survive long enough to be around for the happier days. Like Bob Tanisa used to tell define trend following as this. He says, imagine that every day you've got to go to a Manhattan and you've got a junction on a street corner and you've got your folding chair and you've got your thermos of coffee and you've got your sandwiches and greaseproof paper and you've got to sit there. Well, the morning rush hour comes in and you get jostled around, and then it goes home in the evening, get jostled around, they knock over your thermos, they step on your sandwiches, you've got fumes of cars going by all the day, the weather changes, da-da-da-da-da. And this is a terrible way to spend your life. Until one day, the parade comes by. And you don't know which direction the parade's coming from. But when it does come, you've got the best seat in the house. And that's trend following. The secret is to stay on that street corner.
When you compare, you can have that attitude in life, or you can have the other attitude in life, which to me, and I'm not trying to sound mean, but to some degree, when you're a pure, let's say, equity only buy and hold index person, index investor, you're kind of pretending that it's never going to go down, and you're very comfortable trusting the powers that be to manage those equities and keep them going up. But the objective evidence says we're going to have those 50% melts. So it's just, sometimes I want to use the word delusion. And I'm not trying to talk the trend following book up, so to speak, but I sometimes really wonder how this conversation doesn't open up more honestly to where both types of thinking can go onto the table. Because I think if more people understood the way that you think, Chris, the way that many of your peers think, I think a lot more acceptance would go down.
Yeah. Well, first of all, when we get to this point in any conversation, I would say, well, hang on a second. What are we using? Well, first of all, in my view, there's only two things you need to get right in investment management. One is benchmark selection. Always, always, always pick a benchmark you can beat. And two, time period selection. So if you, with the selection of the right time period, be it 1 year, 5 year, 1 month, 3 days, whatever it is, anybody can look like a genius. And much of asset management is based around that. So I'm not being sort of dismissive of people who say there is no tomorrow's prices, but basically these people are riding along in exactly the same way as they would say that we are riding along. They're only finessing it through benchmark selection and time period analysis. So that would be one point. The next point I'd make is most people would use, for example, in terms of asset management, a stock market index. Let's take, for example, the S&P 500. Well, the S&P 500 is in fact a trading system. It has certain rules, it has a certain number of criteria, and a certain number of rules. The most dominant rule or advantage that system has has the survivor bias. I mean, I haven't noticed Enron being in the S&P 500 recently, or WorldCom, or things like that. So they drop out. So it's only when they're going up are they in. But that's fine. But we also know that about 80% of equity managers who use that in particular index fail to beat it. And there are all sorts of reasons for that, and we won't beat them up on it. But basically, if people are using that as a benchmark, they already, in my view, have surrendered to the wisdom of systematic rules-based trading, which, that we all know, they don't beat. So from when somebody says, well, what if this happens, or what if that happens? What if it does? I don't see how what we do is terribly different from the S&P 500 or any other index that people might want to use. I haven't been in the business for quite a long time. I've heard so many conversations and so many arguments that, for me at least, the evidence is pretty clear and compelling. I mean, systematic trading works better than random trading. Now, I know about the monkeys and the dartboard and this, that, and the other, but the fact of the matter is, none of them have written Shakespeare yet. Systematic, simple rules. I'm not saying it's not possible, but none of them have, to my knowledge. There have been a lot of bad books written, but the monkeys have not yet written Shakespeare.
Your simple rules have some performance drivers. The performance drivers of your G7 currency portfolio. Number one, it's driven by the number of price reversals. Number two, it's driven by the number of losing trades. And number 3, it's driven by profit size and duration of winning trades. Why don't you break those 3 apart individually for the audience?
First of all, if we wanted to, you and I, because we have time and we're bright guys, if we wanted to develop the world's greatest trading system, it wouldn't take us long. What we'd be aiming for is a 3-to-1 win-loss, or 3-to-1 payout, risk over return, and maybe 50-50 win-loss. If we could do that, we'd have all the money in the world. I mean all of the money in the world. I don't mean large allocations, I mean all of the money in the world. We haven't done that. We have been unsuccessful in doing that. What we have got is we're about 60-40 losers over winners on average. In good times, it's better, and in bad times, it's not as good. But basically, 60-40 on win-loss. So 60% of the time, we lose on our trades. So when you look in the back of a commodity magazine, it says by our system, 98% trades winners. I'm, after 35 years, somewhat skeptical, but everybody's got to earn a living.
Hold on. You're telling me that if we buy those things in the back of the magazines that say 98% winners, you're telling me I'm not going to be on easy street? Come on.
Well, I see a lot of young traders, well, not young traders, people come and say, this is the system, we'll introduce people, meet this guy, and you look at the track record and you say, well, Jesus couldn't trade that well. It's just, I do this every day and have done for 30 years or more. Nobody can do that, in my view. There are periods of time when are better or worse than others, but some of these track records you see are a function of time period analysis, benchmark selection, and leverage. So from an investor's point of view, you have to be, I would think, extremely careful and somewhat skeptical going in. In terms of when our system basically has 7 currencies in it, 7 times 7 minus 7 divided by 2, so there should be 21 price streams that we trade. In fact, for reasons of liquidity, obviously, we don't trade all 21. We only trade 16 of them because 16 are the ones that meet our criteria for acceptable liquidity. Now, the computer doesn't look at them as currencies. Computers are clever things and useful things, but all it sees is a row of numbers, 16 rows of numbers, and those rows of numbers have certain characteristics and relationships with the other members of the portfolio. So, for example, if I say dollar-yen to you, you immediately think of Abenomics, or if you think of euro-dollar, you say, well, Europe's in recession, and Draghi, and the computer doesn't think any of that stuff. It's just numbers to the computer. So when we have these 16 rows of numbers, and internally we probably don't even refer to them as currency pairs in the conventional sense that most people do, because for us it is only price. Because price is the only reality. You look at the price, you say, well, that price is too high or that price is too low, and you might be right for all I know, but that's the good news. The bad news is it doesn't change the price. The price is the price, and so that's the main input for us. And when we make a trade, and none of this is new or radical perhaps, but with Larry Hite, for example, all trades, as he said, I think in Market Wizards 1 year, never made a bad trade. Well, is that an arrogant thing to say? No. What he's saying is that all trades are risk equivalent. And why are they risk equivalent? Well, because if you knew that this trade was better than that trade, you wouldn't make that trade, you just make twice as many of this trade. But we don't know that. So all trades are risk equivalent. We bet small. When we win $2.12 or 20 cents, whatever it is, depending on the time equivalent of. And when we lose a dollar. So that's where our edge is. But it's a statistical edge. It's not a knowledge edge, if you get my drift.
Absolutely. Hey, let me clarify too. When you say it's just the computer, that computer is just you and your associates automating yourselves. It's your thinking in the computer. You're telling the computer. The computer's not wildly doing things that you don't know. You're simply saying to the computer, automate our thought process. Here's our systematic thought process. Now go execute it.
That's exactly right. We don't. What we've actually done is, in our business, is just chock a block with cliches. Here's a cliche. In our system, for example, our losing trades are held for about 6 days on average over the 14 and a half years. Our winning trades are held for about 17, 18 days. Okay? Now, in statistical sense, what does that say? Well, what it says is you cut losses and run profits. That's what it looks like. But the idea of doing that, cutting losses and running profits, is a trader's cliche that everybody knows, but for some reason, most people can't do. But it's not hard if you set very simple rules, and that's what we have encoded. But it's not it's not rocket science. We don't have PhDs here. I mean, I would take the view that all the best PhDs probably work for David Harding at Winton. So
he's probably the best one still. I would guess.
He is, everybody else is probably like either his cast off or reject. So why would I hire a PhD? Because what we're encoding isn't in fact that hard.
Hey, listen, you mentioned the duration of trades. Your research, you've shown, though, the number of days for a winning trade appears to matter, but it's different for the number of days for a losing trade. Why don't you explain those differences that you found in research?
When the system is not doing well, what you see is that the period is not because we're losing bigger amounts. There are two reasons that we lose money. One, because in the main, the losing trade holding period remains the same. It is the shortening of the winning trade holding period that is one of the most noticeable statistical phenomena of losing periods. So that's the one that becomes shorter, and of course that results in a higher trading volume. And having said that, our trading volume is positively Jurassic compared to most foreign exchange people. But when in a bad period, you will find that holding period for losing trades remains approximately the same. Holding period for winning trades is foreshortened. But a bad period comes down to that for us, not because we took an absolute bath in this cross or a bath in that cross. That really doesn't happen to us in any sense.
And that's primarily, from having a rules-based approach and the most liquid of markets. This isn't like there's going to be some situation where you can't execute and get out of what you want to get out of or get into what you want to get into.
And that's why we trade what we trade, because if we were to trade, for example, and Lord knows we've looked at it 1,000 times and continually do, and even now we're looking at other currencies, but if you stick to the majors, or these in our case, these 16 crosses, there is a market for those. And more importantly, there is a price, because there is liquidity and you can have some confidence in the price. Yes, there may or may not be a gap, but it'll be a smaller gap than many other financial instruments that you can think of. So if you were to trade the real, or I don't know, the peso or the South African rand or something like that, well, now there is another thing other than price. There's politics, there's all sorts of things. Now, we don't have the foggiest notion how to measure political risk. We don't have the foggiest notion how to measure any risk other than price. And we take the view that if you can't measure it, you can't manage it. I'm not saying that other people can't and can't do so successfully, and I wish them good luck, but I know we can't, and therefore we don't.
Chris, as we wind down, I want to ask you one kind of fun question. I know you're a pretty pragmatic guy. I think the audience can see that, so I'm sure you're not sitting around wishing or hoping. But business would be even more interesting if one day that the powers that be in Europe decided that the euro needed to go back to what it was before the euro. That would give more opportunities, would it not?
Prior to the introduction of the euro, we only traded the Deutsche Mark as a proxy for Europe, and that has to do with correlation or changing correlation. So pre-euro, you could have theoretically 6 or 7 tradable currencies, but in times of great stress or difficulty, you'd actually end up with one position 7 times as large as you hoped it would be. Now, to avoid that, we only ever trade Deutschmark. If it went back to pre-euro currency, so lira and guilder and all that sort of thing, then we would probably take the same view that there is one European currency, and that would probably be the Deutschmark. In other words, we would reverse the decisions we took when the euro was coming in. But they certainly would be exciting and potentially profitable times.
It's an interesting perspective, though, that essentially you were already trading the euro before the euro.
I think we were, and I think many people were. I mean, as I say, what we do is not. It's not unique or clever. I mean, some people might think it is. I don't know, but to me, it's pretty obvious. This is not hard. I mean, you can discount a lot of things very quickly, or you can go on some sort of academic scavenger hunt and convince yourself that you're Einstein, which is fine. It's a big church.
I miss living in London. I miss the dry sarcasm, the academic scavenger hunt. I miss it.
Well, as I say, this is not hard. What is hard is doing it.
Yeah.
It's hard to come in and see that you've got another reversal, and you've got another reversal, and you've got another reversal. That's hard. But the reason that it's worthwhile is because when it does go your way, it goes like a train. And the reason that we take things like reversals and this, that, and the other, and we get whipsawed, which is the sort of no word of trend following, but it's because of what we know is, and I think maybe some investors don't know this, but if you lose $1, it's harder to make back that lost dollar than it is to make a new dollar because of volatility drag. For example, if I lose 25% in the stock market, I don't need to make 25% to get flat. I've got to make 33 1/3% to get flat. That volatility drag is really punitive. It is an additional price for being wrong. The reward for being right is not as great as the reward or the penalty for being wrong.
And I guess with clients also, the reward for being right is, well, you're not allowed to be wrong anymore. Just keep being right all the time.
Well, a rising tide lifts all boats. And, I think everybody, yourself especially, and myself and many others who do what we do the way we do it, we've seen this before, and if we live long enough, we'll see it again. A lot of people get it. We've got a whole generation now of asset managers, young guns who've come in and seen the stock market double.
Yeah, and that's their starting point. I mean, think about how many young people are essentially got started, young traders, professionals, and got started in early 2009, and their frame of reference is simply straight up.
Absolutely. Buy stocks, they go up.
Yeah.
Everybody knows that. We actually saw the similar sort of thing in the 90s, didn't we?
Absolutely.
And you find people who will say to you, they talk as if it's a God-given right to make, back in those times, 20% a year in the stock market. Hello?
I still remember the NASDAQ, what was it, 100% in 1999 it went up. It was crazy.
Absolutely. Yeah. Absolutely. And up it goes. And on average, you're making these huge returns. It's easy. Markets don't exist to make you rich. They're not here for your enrichment or entertainment. They're here to teach you humility. And that's what they do better than anything else that I've ever experienced. They teach you humility. After periods such as this, we forget that markets halved. Why? Markets are doubled. Isn't it brilliant? Let's talk. They're like a bad trader. You do it, just walk through a trading room, and the trader will come and tell, well, you do so and so, that's great, da da. But let me tell you, I bought the yen when it was da da, now it's up. So yeah, okay. So you're telling me you're actually good trades. One of the parts that's missing from the conversation is your bad trades.
So you're sitting here talking about humility, and there's plenty of young traders out there thinking, hold on, but really, what's going on in the office, Chris? You guys are like all jacked up on coffee, and there's a huge adrenaline rush, and there's screens flashing, and everything's popping, and there's bells going off, and you guys are just going at it all day long. I mean, you're just not telling the truth, Chris, about how it really happens at the office.
Well, this place is like a graveyard. We don't allow anybody to watch screens. I mean, we trade once a day at London 1 p.m. and after we make those trades, we're done for the day. That's it.
But that's not a cavalier statement. That's just an objective, factual statement. But as we've been talking this whole conversation, there's a lot of depth of understanding that goes in to allow you to make that kind of objective statement. But you're not trying to be arrogant or like, hey, we only trade at 1 p.m. You're just saying this is a matter of fact. This is what we do operationally based on our system.
Yeah, well, it's the deepest, most liquid time for FX markets, point one. And point two is, again, it's something that we have to do it that way because that makes it measurable. If we came in and decided, for whatever reason, randomness would be a reason, to trade at a different time every day, well, that would be kind of more difficult to measure. So it's not arrogance. In terms of arrogance, I yield to no man, but there is a reason that we do things the way we do things, and I wouldn't for a moment pretend that other people don't have good reasons or better reasons to do things differently. As I say, good luck to them.
Hey, Chris, you guys put out a lot of great research, a lot of pieces of writing, and I know you talked about something I've not had a chance to see yet. Hopefully we can talk again here in the months to come. But where can people go to check out your firm, see some of the papers that you've written, some of the information you've put out? Where can people go?
Well, our website is www.inch.invest. Now, Inch is spelt with a C, so it's INSCH invest.com. Our head of research is Pernod Schneider, and although my name goes on it, and I take partial credit for what she does. In fact, most of the donkey work is done by Pernod and Rivaldi Kwan in London, and Philip Balich, who's also here in Lugano with us.
Is that more of the humility? What you refer to that the trading system and the efforts is the donkey work? I don't know if I've heard that one before, but I love it.
Well, there might be somebody who has a sort of a spark of genius, like the Sistine Chapel, the spark from the finger, and I would credit myself as occasionally I come up with a good idea, but rather like trades, most of my ideas are bad ideas. They have to be researched and tested, and Rivaldi and Philip do that. And so again, exactly the same as I just said about trade. Most of the things I think of fail to pass scrutiny in the end, but some of the research reports that do come out, we are often complimented on it. And the great thing about being us is that we're beholden to nobody. I don't have to trade through anybody. I don't have to do anything for anybody or to anybody. And I really don't care what anybody might say. So on that basis, we are pretty free in looking at what we look at and concluding whatever it is that we conclude.
I think for the audience out there, whether it might be a potential new investor to your firm or an established investor or just a young person looking to learn from you and your associates and your work, go look at Chris's track record. Just go look at the monthly ups and downs, look at the annual totals, just look at everything and observe that it's not all black ink. There's some red ink in there. And I think that's what for me, I've always taken that when you look at a trend following track record and you look at that red ink, if you don't see the red ink, there's trouble. If there's no red ink, it's not trend following.
You're absolutely, completely correct about that. And that's what I tried to allude to in the morning. I see some earlier in our conversation, I see some track records and I look at it and with the one blink test fail. I don't think so.
Yeah,
I don't think so. And I'd hate to be cynical about this, but going back into those olden days, if people or clients are making allocations to trend followers, guess what? You see a hell of a lot more people describe themselves as trend followers. So, and extend that to managed futures. If managed futures does really well, guess what? Megabank PLC or whatever, they produce a managed futures fund. Do they know anything about it? Not a bit. But that's okay because they're paid on assets under management. Yeah. Do you see what I mean? If there is a demand, supply and demand, the supply will rise to meet the demand, and that's true of investment management. So if, for example, trend followers over the next 3, 4, 5 years do really, really well, you'll see a lot of people rebadging themselves as trend followers. It's to be expected. It's obvious.
As you mentioned that quick peak idea, I always say, and I've said this before, if you see a track record And for example, I can think of two famous track records in the last 15 years, Bernard Madoff's, which was a scam, and long-term capital management's, which was just a bad process. But both of them showed you that consistent 1 or 2% a month. And so to me, it's like if you see, and this might sound crazy to investors, if you see a track record that shows plus 1% for every month of the year, that scares me more than a track record that might show a minus 7% or a minus 8% a month. It's the plus 1% every month that should scare the bejesus out of you.
Me too, because it is simply not doable in my experience. You know, as I say, these places aren't there for your enrichment, and somebody who's going to make 1.25% a month and has done for the last 42 months, and I'm sorry, fill your boots, write the check, but for me, no.
When you see that track record, there's something else going on besides the track record. The track record is funky, to say the least.
Yeah, but there's a lot of it about.
Yeah. Hey, Chris, listen, great conversation. And I want people to go check out your website, check out your writings. And like I said, hopefully we can talk again in the future. And like I said, I go back to reading that opening quote that I put in my book. And my gosh, I probably found that 2002, 2003 when I first saw it. So I pulled it up today. I was like, I got to pull that quote up that I put in my book from Chris. So.
Well, since those days, which is a long time, it's got to be well over 10 years, I can assure you we haven't learned any more new things, but we've learned more about what we don't know. That's for sure.
Well, as you say, with humility, there's another humility statement right there. Hey, Chris, I appreciate you coming on today, and thank you again.
Thank you very much indeed, Michael. Thank you. Bye-bye.
Hey, seriously, if you did not learn something today from those 4 guests, retire. It's over. You're done. You don't have a snowball's chance in hell to succeed. If those 4 men did not influence you, inspire you, get you to see something different, and all you want to do is own an index fund, you're finished. Turn my podcast off. Please don't listen anymore. It's all over. But for those of you that got it, aren't we so lucky? Aren't we so lucky to have such wisdom, decades of wisdom, literally decades of wisdom thrown upon us? I always feel fortunate to do this show, and I hope it always continues. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.